every company now, as we saw with Uber and Lyft and Shopify and MindBody, should be thinking about how to leverage financial services to better serve their customers, better retain their customers, and drive more margin. Based on the attendee list, about 10% of you work in financial services. I believe that if no one in this room changes jobs, 5 years from now, that number will be closer to 80%. And that's because in the not-too-distant future, nearly every company will be a financial services company and get a significant portion of their revenue from financial services. We're going to talk today about the infrastructure that is driving this fundamental transformation, and more importantly, how it's going to fundamentally change banking for everyone. For startups, you'll be able to launch your companies faster and cheaper. For existing financial services institutions, you might finally be able to launch new products quickly or spend less on IT maintenance. For every single company, even those that have nothing to do with financial services today, you'll have the opportunity to launch fintech for the first time. And finally, all of those benefits will accrue to us as consumers in the form of more choice, better products, and more affordable prices. And this change is so badly needed. The current state of the industry is pretty poor. Let's take a look at banking today. Many of us probably feel apathetic towards our banks. But if you're part of the millennial or Gen Z generation who saw your parents go through the financial crisis, 28% trust their banks to be fair and honest. These are the institutions that hold their money. That is a far cry from providing delightful products. And that's if you're lucky enough to have access. 50% of Americans live paycheck to paycheck, and often live in an entirely different financial services system. They need financial services more, they have fewer options, and they're much more expensive. In these situations, you most definitely don't love your banks. So why has the status quo persisted for so long, despite extreme levels of customer dissatisfaction? Innovation in any industry is hard. Innovation in financial services is very hard. If you take the existing institutions, many of which have been around for over 100 years, they have a large brick-and-mortar retail footprint. So it's hard to cut costs quickly. Think tons of long-term leases. And then it's hard to roll out new products quickly. You're training thousands of employees across the country. Then we read about these billion-dollar-plus IT budgets, but at some of the larger banks, 75% of those dollars are spent on maintaining the products that you don't already love. So this is an opportunity for startups, but there's huge challenges here too. It's a highly regulated industry. You're dealing with multiple regulators across state and federal. And then, as we'll see shortly, it has a very complex infrastructure. Given all of these challenges, why am I so optimistic about the future? There's a parallel here. It used to be really hard to start a software company. Many of you probably remember in the audience, 10 to 15 years ago, your first step would be driving to a computer store. You'd buy physical servers. You'd probably load them up in a truck that you'd borrowed. You'd drive them back to your office to rack them in a server room. You'd buy some software licenses. You'd write some code for a database. Hundreds of thousands, if not millions of dollars later, you could finally start building the product that you wanted to bring to market. Now, this sounds totally anachronistic because it is. Today, anybody can get started with a credit card and a laptop sitting anywhere. Why? Amazon Web Services brought all of this infrastructure as a service. It dramatically reduced the cost and complexity, but what it really did was unleash thousands of experiments. Think of a company like Airbnb. Imagine if Airbnb had had to go to investors and convince them to give Airbnb millions of dollars just to build the infrastructure so they could earn the right to run the experiment to prove that, yes, there's a massive market where we all want to stay in strangers' homes. it might have turned out differently. Now, this same monumental as-a-service change is coming to financial services. And as we'll see shortly, it's not just one company, it's multiple companies because the infrastructure is so complex. But it'll reduce the cost, it'll reduce the complexity, and importantly, it'll unleash thousands of experiments that will become our large financial services companies of the future. Now, we would expect this innovation to come from startups, to come from existing financial services institutions. But a great majority of it, I think, will come from companies that are adding financial services for the very first time. And it's already happening. Apple just launched a credit card. Now, for the fintech nerds in the audience, this was a highly anticipated move. But not that long ago, Apple was your computer company. And now they're hoping you're going to like their credit card as much as you like their iPhone. And it could be easy to dismiss Apple because they're known for launching new products. They're sitting on billions of dollars of cash. But this trend is already happening more broadly. Take Uber and Lyft. These are ride-sharing companies, right? Yes, but if you're a driver, they might also be your banking companies. And this does two things. Uber and Lyft both spend hundreds of dollars acquiring drivers. And then they have to make up that cost through margin on rides. It's much faster to make up that cost if they also have margin on banking services. Then if I'm a driver, I'm probably more likely to stay with a company that is also providing my financial services. Ultimately, if successful, Uber and Lyft might need to acquire fewer drivers. This is not just a consumer phenomenon. It's also happening in B2B. Take Shopify. They provide website services for any merchant for a monthly subscription fee. Or another company like MindBody, which will help fitness studios like yoga studios manage their businesses, also for a monthly fee. Turns out, both of these companies make almost 50% of their revenue through financial services. So why is all this happening now? Really, it's the notion of as-a-service infrastructure is coming to banking. And to understand why this is such a big deal, we need to look at how complex the banking stack is today. Ever wonder what it takes to start a bank? Here we're going to take a simplified version of what this looks like on the consumer side, starting at the bottom. This is a highly regulated industry. You need a license. You can go apply for a license, but that could take years. So what most of the new companies are doing is they're finding a sponsor bank, or they're borrowing a license. Here's your first set of partnerships. Then you need a database or a core system to help determine where are your customers' money, how is it moving around. Your customers probably want to get money out of their accounts. You need to integrate with a series of payment systems. If you want to make loans, you're going to need to know information about them, enter the credit bureaus. Again, regulation, multiple regulatory agencies that you need to comply with. And then we're dealing with money, so of course, there's going to be fraud. So now we're looking at probably over a dozen partnerships, close to 2 years to ink these deals. And you've built absolutely nothing new that you wanted to bring to market. But what if, in the same way Amazon did to compute and storage, there were companies that were taking each layer of this stack and providing it as a service? And that's exactly what's happening. Let's take a look at a few examples. To start, I want to build a simple budgeting or financial planning application. So I'm not trying to rebuild the stack. I'm just trying to get data out of the stack. Sounds easy, right? Not really when you dive into it. Let's say I wanted to serve everyone in this room. I would need to know everything about all of your accounts. Let's start with the banks. There's thousands across the US. I'm guessing I'd need at least a few hundred to have coverage. And then all of these banks have multiple different core systems, different data formats. There's a whole pile of integrations. Then I need to know about your brokerage accounts. Maybe I want more detail about your payroll. Many of you probably have student loans. This is an entirely different set of integrations. You can easily see how I can spend all of my time building the infrastructure, and I haven't even built this great financial planning application that I wanted to bring to market. But now, There's a company like Plaid that provides all of that as a service. Instead of hundreds of integrations, I now just have one. Plaid builds the integrations, it maintains the integrations, and importantly, it translates the data into a usable format. And this has helped accelerate companies like Earnin that allow me to get access early to my paycheck, money that I've already earned. Or Blend, which is a streamlined mortgage application. So instead of faxing in months of bank statements and brokerage statements, like I'm sure many of us have done, you can just link your bank accounts and be done. What could be coming next? Anyone with student loans will recognize this beautiful 1970s-like interface that still persists in 2019. Why is it still so terrible? Part of the reason is that it was only recently that the connections into the servicers and the infrastructure has been built. So I think in the not-too-distant future, we're going to see a lot of improvements in this industry. Let's look at another example. You have a great idea for a checking account and a debit card. This is going to bring us back to the stack that we just went through. But I provided a very simplified explanation. To actually pull this off, you're going to need many more partnerships. You probably need an ATM network. You might want your customers to be able to remotely deposit their checks. And then, oh, by the way, a lot of these systems were built in the 1960s. And so you're writing a whole lot of code to stitch them together and to enable you what you want to do. But again, now we have a company like Synapse that provides all of this as a service. And this does two things. First, it enables you as the entrepreneur to focus on what is it that you really want to bring to market that's new and different. So for instance, Mercury, which is a small business or startup bank that focuses on fast account opening and providing great cash flow visibility into your business. The number one reason that a lot of companies go out of business. Or second, what it does is it places a much bigger importance on, do you have a deep customer understanding, and hence a really great idea of a product that customers need and a great idea around distribution, versus do you come from a banking infrastructure or payments background? Propel is a company that serves some of the 40 million families that are on food stamps. One of their founders grew up on food stamps and had deep, deep insights into this market. They started with budgeting services and are now layering on financial services. So let's take a deeper look at one of the layers, regulation. Many industries are regulated. If you don't comply, you'll get a fine. If you don't comply with regulation in financial services, you're going to go to jail. And for anyone who's seen Ozark on Netflix, you would know the lengths to which criminals go to get illegal money, for instance from drug trade, into the legal system. Things like buying a cash flow heavy business where you can easily cook the books. Or more creatively, you can break up your deposits into tiny amounts so that they don't trigger the anti-money laundering systems. There's a term for this. It's called smurfing. So banks are required to comply with a set of laws that's intended to prevent anti-money laundering. It goes something like this. They monitor hundreds of lists around the world, sanctions lists, terrorist lists, and then on top of that, they have to monitor all of our transactions. And as you can imagine, this results in two things. Many false positives, legitimate customers trying to use bank that get blocked, a very frustrating customer experience, or just a ton of manual reviews. If this sounds cumbersome, to put some numbers around it, at one of the large banks, 30,000 of 210,000 employees work only in compliance. The vast majority of them are processing suspicious activity reports from anti-money laundering. What might be more surprising, though, is that less than 3% of the dollars are actually caught. Again, big opportunity for technology to provide this as a service. Comply Advantage, to start, does all of these integrations for you. So instead of hundreds, you've moved down to just one. Then what they also do is provide much more granular risk controls so that the banks can spend less time monitoring all of our transactions and more time focusing on people who might actually be laundering money. This yields a better customer experience, lower costs, and hopefully over time, a much higher success rate. One of the big challenges in this market is that once one bank gets really good at catching money launderers, the launderers move to a weaker point in the system. And this is also the case with another group, the fraudsters. Many of us think of fraud as stolen identities, but there's actually a much more pernicious type of fraud, and that is completely fabricated or synthetic identities. And here's what the heads of data scientists at a lending company discovered. They're looking through the database one day, and they see a rather obscure name linked to 13 different social security numbers. Like, well, how can this be? This is fairly easy to solve. Let's go see which one of these pairs has a credit profile. Turns out they all had credit profiles. This is easier to do than you might think. You can pick almost any 9-digit number that doesn't start with 9 at random. It could be a legitimate social security number. Then you go apply for a loan. The first time, the lender will come back and say, nope, never seen this person. But then the next time, the lender will ping the credit bureau, and the credit bureau will say, oh, yes, there's been an inquiry. Chances are you can find a lender that, for a high enough cost and a low enough dollar rate, will actually give you a loan. And then these synthetic made-up people, they pay back the loan, they ladder up, they get more and more and more, until at a certain point, it makes sense they've got enough money and they just bust out. This is a very difficult type of fraud to catch. But now we have a company like Sentilink that does all of this as a service. Turns out fake people take out loans at much different rates than real people. And if you're focused on it, you can stop this kind of fraud much more effectively. Keeping fraud to minimum levels can be the difference between a profitable lender and a lender going completely out of business. And they've been able to significantly reduce fraud across all categories, from auto to personal to small business. Now, these are just a few examples of the new infrastructure companies that are completely remaking this financial stack and providing it to all of us as a service. And this is a massive opportunity in the US, but it's an even bigger opportunity worldwide. Some of these companies we talked about are already going to be global. But across the world, regulation is different, the payment systems are different. In some cases, the financial services stack will be entirely different. Take a country like Mexico, where 80% of the payments are in cash. They're going to need a layer that helps get cash payments into the online system. Now, what's so unique about this disruption is that oftentimes there's one winner and there's a ton of losers. But in this case, everyone has the opportunity to participate and improve significantly. For startups, we've seen some of the examples of the new infrastructure companies that are being built, and there's many more opportunities there. But there's even more opportunities in the thousands of experiments that are going to be unleashed on top. Last year alone, there were close to 2,000 fintech companies that were launched. For existing financial institutions, you might finally be able to replace some of your legacy systems and spend less on maintenance and more on launching new products. Or potentially launching them even faster by partnering with some of the startups. Every company now, as we saw with Uber and Lyft, and Shopify and MindBody, should be thinking about how to leverage financial services to better serve their customers, better retain their customers, and drive more margin. And finally, the really exciting part comes to us as consumers. With new financial services companies spinning up, our existing services getting better, and maybe even some of our favorite brands launching financial services, I believe that in the not-too-distant future, everyone, no matter their socioeconomic demographic, no matter where they live in the world, will have access to affordable financial services, and we might even love them. Thank you.